This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore.
So this is the week before Christmas.
Yeah.
We will have new material next week and the week of New Year's, but we had some good stuff this week we covered off.
Yeah, we talked a bit about some, podcast housekeeping items, just some stuff more specific to the podcast than to investing or financial markets, but still important for us to talk about.
Covered off the client survey we recently did, had some interesting data from that.
And we talked about the market volatility, and that was pretty much it. It was a good little episode.
But it's timely, I think, so it's important information to share, so have a listen.
Yep, we'll talk to everybody. I guess I was going to say see ya, but we'll talk to you in the new year. Welcome to episode 25 of the Rational Reminder Podcast. It was a bit of an interesting weekend for the podcast. We jumped in the charts. It was kind of fun for Cameron and I to watch, but I think we peaked at number 13 in the business category for all podcasts in Canada.
And with some pretty big names.
Yep. And we were number 3 in the investing category. So as you get more niche, I guess it's probably easier to get high up in the charts. But in the investing category, we topped out at number 3. We've dropped off since then, but it was fun while it lasted.
Yeah, and if you're listening to the podcast and you do enjoy it, we would love to hear your feedback, and any reviews that you can leave would be great.
Yeah, it's always, it's exciting. This is like my 4th child. I had to think about how many kids I have. This is like my 4th child. So when we get a rating or a review, it's always, it's nice.
It's not always nice. We got one last week, which, while nice to get the review, I know you texted me right away and copied and pasted over to me. So why don't you talk about the review we did get?
Yeah, so this is the first time that we've gotten critical feedback through the iTunes review system. We've gotten lots of positive feedback, but this is the first one that was, I don't know if I'd call it negative. I think we called it constructive. The listener wrote that they've actually stopped listening to the podcast, according to them, and they've unsubscribed. And their complaint was that we do too much selling. We're selling our business too much.
But they said that they understand that's the point of it, and that's actually not the point of the podcast.
And we don't feel like we're selling.
No, we just think it's important to take advantage of technology that allows us to share what we're thinking. We had a lot of clients ask for that. It happens to be a great medium to be able to do that.
But anyway, if we come across as selling our business, we apologize. And if people do feel that way, we are conscious of it now. So we'll be extra careful. And sorry if we offended anyone, I guess.
So this is the last time we'll be in the studio for 2018.
People don't know we're in the studio.
Well, so we have our new studio. People may have seen it online on Twitter and LinkedIn, but we have a new studio. So this is our last recording. We will have original episodes coming up next week. Special guest that I recorded a month or so ago in Los Angeles. And then the week after, we have another guest.
Do you want to say who the guest is? It's a pretty cool guest.
A pretty cool guest. The guest is the co-executive producer of The Big Bang Theory, Dave Getch. Very interesting interview. He was a great guy, really fascinating the impact that this philosophy had on him. And then the week of New Year's will be with Robin Powell, who is with the TEBI, the evidence-based investor. Again, fabulous interview. He had a lot of great insights on what's happening in the UK.
Yeah, he's done a lot of work in generating media to support evidence-based investing. Anyway, 2 good conversations. So even though we're not recording, we will have stuff coming out. And I think it's worth talking a little bit more about the studio. You kind of just glossed over it, but within our office here at PWL in Ottawa, it's a closet. It was a closet. We actually gutted a closet and put the foam sound padding up, got a little Rational Reminder sign in here. But this is where we'll be recording the podcast from going forward. And we've actually got 2 video cameras in here. So starting, I don't know when we're ready, I guess, we're going to start filming ourselves recording the podcast and posting those videos on YouTube. So hopefully that's nice for some people.
Yeah, and it's amazing. We're actually almost 6 months into podcasting. So it has been fun. And the goal is to always improve them. Again, any feedback, love to hear it.
Yep. And to finish off the year, because we are rounding it out, like Cameron said, we did want to give a couple thank yous. Matthew Passy, who's our producer, he's been with us for a few months now. He's been fantastic. So thank you to Matthew. And the PWL marketing team has also been very supportive of the podcast. So thanks to all those people. Anyway.
So do you want to talk about the client survey that we did?
Yeah. So we participate in a client survey. Is it every year or every couple of years?
It has been every year now.
Every year, yeah. So it goes out to a bunch of advisors within our peer group. And we had 199 survey responses, which is pretty good. That's about half of our...
I'd say roughly half of clients participated.
That's good.
And then we get to compare those results to the clients responded to other advisors in our peer group across the country. So there were 6,874 total clients in the pool. So it's neat how we get to compare our data with other peer firms. Some of the outliers really jumped out at me. I don't know if you noticed this or not, but 21% of our responses were age 35 or younger. Compare that to the group, which had 3%.
Yeah, it's crazy. Well, it's a big problem within the whole wealth management business, right? Is that the client demographic, there are so many older clients and older advisors too.
Older advisors. I think the average advisor age, I think, is 54.
Yeah, sounds about right.
So, I mean, we have a lot of younger people in our team. You're 31?
Turned 31 yesterday.
31 as of yesterday, and I'm 52. So certainly our average age is younger than the average age in the industry. And we also had far fewer clients over the age of 55. So of the participants, we had 42% over the age of 55, and the group average was, group had 79% of respondents over the age of 55.
Yeah, it's neat data. There's some other cool stuff in there too, like the things that people value the most, which is experience with clients like them, returns, which I guess you'd expect because that is clearly important. And one of the most interesting pieces of that survey question was that the higher the net worth of the respondent, the more important returns and fees came. I wonder what does that tell us? People are more aware as their assets grow?
Or I think people perhaps look at fees in dollar terms, not percentage terms.
Could be.
You take on a large portfolio, even a small percentage of a large portfolio becomes a large line item expense.
Yeah.
Some of the values received that they saw in service, sense of security, peace of mind, no real surprise there, I guess, knowledge of their personal financial situation, progress towards their goals, and again, returns.
Yeah, that's interesting. Interesting to see what people who are actually receiving financial advice see as the value of paying for advice.
And then there's one question about expectation of annual returns going forward for the stock market.
I thought this was a funny question. Like, why would they ask clients responding to a survey about, is it to just gauge how their expectations are going to match up with reality, or
pick up in the greed factor? I also thought the bands were kind of wide. So 35% said between 0 and 5%, and 45% said between 6 and 10. And hardly anyone had expectations over 10%. That surprised me. I thought a lot of people would have expected higher returns than that.
It's funny that the majority of respondents to that question, 45% between 6 and 10%, that's more than we would expect for a 100% equity portfolio on average over the long term. So are people's expectations higher than they should be for portfolio returns?
So one other piece of feedback that was the most persistent in the write-in, and I think a lot of clients may understand this, so we had a lot of feedback about the online experience clients have with us. I know this is very near and dear to your heart.
Yeah, we've been talking about it for years, and it's been a challenge to actually do anything about it because we've always taken the position that we don't want to become a technology company because that's not who we are. But at the same time, there have not been any third parties providing the services that we need in terms of technology. But we know, especially based on this recent survey, that it's a major pain point for clients, and we're working on it.
Yeah, we heard loud and clear, and we're actively working on it now. We think we found a solution. So
I hope we have an announcement within 4 months. I don't think that's overpromising. Anyway, so last week we had that wasn't last week. Sorry, that was when was Glenn? Three episodes
two or
ago?
3 weeks ago. Glenn Cooke.
So we had Glenn Cooke, he's the founder of Life Insurance Canada website. He came on to talk about life insurance, clearly. And Michael James, who's one of my favorite Canadian personal finance bloggers. I don't know if he read the transcript or listened to the podcast. If you listen to the podcast, that's pretty cool. I think Michael James he's pretty cool. But anyway, he picked up that episode with Glenn and he wrote a blog post about it. So what Michael found interesting was the reasons Glenn gave for when you would buy permanent life insurance. Michael kind of said, I never really got when you would do that before, but after listening or reading or whatever it was, he got it. So what Glenn said was, if you have max RSPs and TFSAs, if you want to guarantee a death benefit, so like Glenn during the podcast gave the example that he grew up without financial means, so he wants to make sure his kids have financial means when he dies. Therefore, he's got permanent life insurance. And the last reason that Glenn gave was if you want to make your legacy as large as possible, and that one hinges on the idea that insurance will grow faster than investments after tax if you're investing in a taxable account. So Michael he kind of gave commentary on Glenn's reasoning, but one of Michael's comments was that he would need to dig into the details of a universal life insurance policy to understand if that's true, if you can actually build more wealth with insurance than you can with a portfolio. Now, we've looked at that, so we can talk about it. It was probably 2 or 3 years ago that we really dug into this, but I don't think it would have changed. So in the past, when we looked at it, even if you're taxed the highest marginal tax rate, it's really tough to claim that you're going to get a better return through insurance at death, at normal life expectancy, than you would get through stocks, even with taxes taken into account.
Yeah, maybe less volatile.
Yeah.
Especially at end of life, if that happens to be a bad time in the markets, there's always that risk at that point in time.
That argument, but given a long enough, like say it's someone who's 30 years old or 40 years old, given a long enough time horizon, you'd expect...
Especially with the low-cost investment options available today.
That's another big part of that conversation, yeah. Well, the cost inside of the UL policy, because you could make the argument that, well, you can buy an equity index in a UL policy, but you're going to pay a 2.5% fee.
Correct. You can't get the same cost structure.
So anyway, you can't really compare, even after tax, you can't really compare equities and insurance. But you can very easily compare taxable fixed income investments to, say, a universal life insurance policy with a guaranteed investment inside of it, which would have a low fee. Like if you're buying GICs or whatever inside of a UL policy, you don't have those high seg fund type fees. So anyway, to answer Michael's question, not that he asked us this question, but to respond to Michael's comment, if you think about it from an asset allocation perspective, if you want to add in insurance to your overall asset allocation to build your wealth in a tax efficient manner, you can do that, but it means that you're replacing fixed income with permanent insurance. So if you take, 10% of your assets and put it into a permanent insurance policy, that becomes part of your fixed income. Yep. Now, what's the implication of that? You
have to make sure you have more equities. So if you were 60-40 before, maybe now you're 70-30.
Right. So it's not like you just go, if you're a 60-40 investor, you go put 10% of your net worth into permanent insurance policy and expect to have more wealth at the end. It's not the case because now you've decreased your equity exposure effectively. So if the goal is really to maximize after-tax wealth, whatever you allocate toward insurance counts as fixed income, which means your financial market portfolio gets more aggressive, which might make you sad. If you're a 60-40 investor and you're stuck with a 70-30 portfolio, it takes a certain level of rationality to live with a 70-30, understanding that you have 10% in a permanent policy. So anyway, those are our thoughts on that. We did have a pretty good listener question.
That was a very good question, actually. So basically, he's a fan of behavior-based explanation for factors, which is what we talked about. So small cap investing, smaller stocks are riskier, therefore have a higher expected return. Value stocks, which are stocks that have gone down in price, they've gone down in price for a reason. There's a risk story to explain the higher expected return. But if two stocks have the same size factor and the same value or price factor, but one is more profitable than the other, how can the profitable stock be riskier? That was the question.
It was basically saying, like, in the last podcast, we took that deep dive into factors and we kind of not bashed, but just we stated that we're not the biggest fans of behavioral explanations for factors. So like size and value, you can make behavioral.
But how is being profitable riskier?
Right. So that's the big question,
right?
So they said, okay, I hear you guys, you don't like behavioral explanations, but I also know that you guys like the profitability factor. So how do you reconcile that?
Exactly.
Why would a more profitable stock be riskier? So we do have a risk-based explanation for how that works in a portfolio. And what it is that when you take two stocks, like what Cameron said, you take two stocks and you hold constant size and relative price. So market cap is the same and the exposure to value. So that's what I said, the relative price. So size and relative price are the same, but one's more profitable. The one that's more profitable has got to be riskier. And the reason it has to be riskier is because it has the same relative price as the less profitable stock.
So the market is pushing the price down to that level, even though it's making a profit.
It's discounting the additional profits at a higher rate, which means it's a riskier asset. So that's the risk-based explanation for profitability in portfolios. And there are other ones too.
Interesting thing about risk is that risk isn't arbitraged away, because people might say, well, if that's the case, people would arbitrage that away over time and how they price those assets. But no, if it's riskier, you have to command a higher expected return. Otherwise, why would you invest in it?
This is why I can't say that we disagree with behavioral explanations for factors, because there's a ton of fantastic research and data showing that they make sense. The challenge that I have with behavioral explanations, and I don't want to go too deep into this because we talked about it last time, but the challenge that I have with behavioral explanations is that they can be arbitraged away if people can behave more rationally. Now, will people behave more rationally? Who knows? But will risk go away? Will people all of a sudden be willing to take more risk without the additional expected return? No, that doesn't change.
We had a client ask a question this week, which we have to do more research on, but about a market timing model that has been shown to deliver higher expected returns. And I'm like, well, what's the reason for that higher expected returns? Everyone has access to the same data. And if someone else finds that data, that can be arbitraged away because there's no reason to expect that model to persistently deliver higher expected returns.
Yeah, I mean, the behavioral explanations hinge on people behaving irrationally and limits to arbitrage. There are reasons that people will not arbitrage things away. And that's what behavioral explanations for factors hinge on. We had a long conversation about that recently. But again, I'm not comfortable taking clients' money and investing it based on other people's behavioral biases or limits to arbitrage. Because if someone figures out a way to get around the limit,
or a model is not rooted in academic evidence.
Yeah. Anyway, so that we gave the risk-based explanation for profitability, and we kind of dug into why. We reiterated why we're not crazy about behavioral explanations for factors.
So given what's happening in the markets, do you think we should maybe talk about that a little bit?
Oh, you mean you want to go to cash?
I'm not suggesting that, but I think it's good to kind of review what's been happening.
Yeah. All around, it's been a pretty bad year in the stock market. Canada, by the S&P TSX, is down about 9% for the calendar year to date. And U.S. market is up a little bit in Canadian dollar terms.
Yeah, thanks to currency,
but down in U.S. dollars, or down for a Canadian hedged investor. And international, and I just looked at XEF, which is an international equity ETF listed in Canada. So this is a Canadian dollar return.
Taking currency, yeah.
It's down 7.17% for the year. And the DFA 60/40 portfolio is down just over 5.5%.
So kind of garden variety volatility, right? If you just look at the numbers, there's nothing that dramatic there.
Well, it's nothing that dramatic when we're talking about percentage points, but when you're looking at the numbers, they add up. 5% on a $500,000 portfolio. That's not a small negative number to see in an account. So I get that people feel anxious, but you're right. This is garden variety. This is nothing. And
we also have a whole generation of investors that have had a great decade since 2008 and haven't really seen a lot of real downside. And I can tell you, this is nothing like 2008 downside at all.
I asked you about that this morning because people are nervous now, and we always talk about how we never get client phone calls, and we haven't had any recently, but we've had more than zero. And so I asked you, like, what was it like in 2008? Like, if people are nervous now and people are asking us for reassurance now, I mean, this year's negative return was maybe a day.
Oh, absolutely. There were days back then, and the market was a lot lower, where the Dow would be down 400, 500, 600 points day after day, just getting knocked down like crazy. You see assets just melt away. Like we were down, 15, 20, 25%. And these are diversified portfolios.
Yeah. You mentioned that we've got a generation of people who haven't seen much or any real volatility. I found one post about that was, it's crazy. I almost find the data hard to believe, but it's data, so you can't not believe it. It is what it is. But it was a post by Jared Kaiser, he's with Buckingham, which is kind of like a similar-ish firm to PWL in the States. And he wrote about how from March 2009 through October of 2018, the S&P 500 has had returns that it would not be unreasonable for nobody that is alive to ever see again. That's how good they were on a risk-adjusted basis. So the percentages, and this is from March 2009 through November, because I got more recent data than he had.
From the bottom, March 2009 was the bottom.
So annualized return of 16.97% with a standard deviation of 12.44%. Now I had somewhere else in my notes for a different point, but that's significantly higher returns with significantly lower volatility than the broad history of the S&P 500 going back to 1926. Now, what Jared Kaiser did in this post is he took all of the monthly returns from 1926 through October 2018, and he used a method called bootstrapping to create 100,000 116-month periods. So 116 months is
So it's 90 years of monthly data in a pile, in a bucket.
Correct.
And you go and you pull from that bucket to bootstrap into your sample, then throw the number back in and re-pull.
Correct. So you record the number, put it back in the bucket, pull the next one out, And the significance of 116 months is that that's the number of months from March 2009 through October 2018. So
he replicated that time series on a bootstrap basis from over 90 years of data.
Correct.
Got it.
So if we assume that, and it's not reality, obviously, but if we assume that every possible monthly return is captured in that big data set, obviously it's a model, it's not reality. But if we make that assumption, then what we can do is recreate 100,000 variations of reality. So his finding, it blew me away, and he wrote in the post about it that it blew him away too, is that of the 100,000 samples, only 0.57%, so less than 1%, nearly half of 1%, of the 100,000 samples produced risk-adjusted returns as good as or better than the actual returns of the S&P 500 over that time period.
So we have a generation of investors that have experienced something that is so unlikely to ever happen again.
Yeah. Well, Kaiser writes in the post that probably nobody who's alive now will ever see returns like that again anywhere. And so it speaks to your point, though. There's a whole, that's 2009 through 2018. So that's roughly 10 years where anybody that started investing over that time period, of course you're not.
So we have a generation of basically take a more risk, you get more return. So you have risk seekers as opposed to risk avoiders, because you really don't know what it's like until you live through it.
Right. I'm probably guilty of that too. Maybe, I don't know. I feel like I'm pretty good at being detached emotionally, but I'm 100% stocks. I don't worry about the value of my accounts, but you're right. I have not lived through a 50% drop. Anyway, so this whole thing kind of got us thinking about what is normal volatility. So we know the S&P 500 had, Jared Kaiser wrote the post was called "The S&P 500 Goes Supernova." So we know the S&P 500 has gone supernova over the last 10 or so years, and we're probably never going to see that again. But when we look at the broad set of data, what does normal actually look like? So we didn't do anything fancy, but we didn't really need to. You go back to 1980 for global stocks, and this is using the MSCI World Index. There have been 11 corrections of 10% or more, and 8 bear markets with a decline of 20% or more that lasted at least 2 months. So, clearly where we are now, we are not even really close to a 10% decline all around the world. So we're not even in that.
Yes, that's global. That's not just the U.S. market.
No, that's global stocks, correct.
So if you have a global portfolio.
It's not overweight Canada thing. That's just global, and that's in U.S. dollars.
So it's roughly every 3 years, you have a correction of 10% or more.
Right.
And every 4 to 5 years, you have a decline of 20% or more.
Right. Now, this year, from the high point of 2018 to the low, which is basically now, the S&P 500 has had a drop of 13%. So that's not the year drop. That's from the high point because it went up for a bit to the low point now. So 13%. Now, we started wondering, okay, like how abnormal is that if it is abnormal at all? So all we did is we looked at the annualized return of a few indexes and overlaid the standard deviation and just moved one standard deviation from the mean, left and right, just to look at what is a normal return. And we'll talk about the numbers, but basically we're so well within normal that it's not even worth talking about almost. But it is because people are nervous.
So one standard deviation is how much in terms of time?
Well, it's 68% of outcomes are captured within one standard deviation
each side
of the mean.
So going back to 1926, the data you dug up, the S&P 500 has had an annualized return of just over 10% with an annualized standard deviation of between 18 and 19%.
18.62 to be precise. And that's just, we have to come back to the S&P 500 going supernova post where you remember the return was it was 16.97% with a standard deviation of 12.44. And you look at the full data set and it's got
60% higher return with whatever that is, 40% less standard deviation.
Yeah. So I thought that in itself was...
But the band on that, then let's just round it just to make the math easy. So 10% plus or minus, call it 19.
Sure.
2/3 of the time. So 10 minus 19 is minus 9. So 2/3, or I guess in a normal distribution, 1/3 would be negative or below the expected mean.
Right.
So these are absolutely normal bands that we're in right now.
Yeah, I mean the spread for one standard deviation on either side of the average return for the S&P 500 going back to 1926, we're looking at between negative 8.5% and positive 28.73%. So for U.S. stocks anyway, they're slightly negative in U.S. dollars, slightly positive in Canadian dollars. But either way, we're within one standard deviation of the mean. So that is I mean, that's the definition of normal. That's the closest to the mean in a standard normal distribution. So we looked at Canadian stocks too. Annualized return going back to 1956 of 8.89%, standard deviation of 14.9%. So this year we're bumping up on the second standard deviation from the mean for Canadian returns. But still, I mean, we are within the normal distribution. That is the definition of a normal return, assuming that returns are normally distributed, which they're not perfectly, but that's okay.
And while you may not be happy, if you have a proper strategy that you know is being rebalanced, you won't be upset.
Right. Ken Fisher had a great tweet. When prices go down, so markets are down right now, and like you're saying, some people are feeling nervous or sad or whatever, but Ken Fisher tweeted, "Can't you just feel the falling market making people who were more optimistic become more pessimistic? Rationality would argue for lower prices, making people even more optimistic." It's true. Prices go down, expected returns go up.
If you believe in capitalism.
Right. Ken Fisher's the gospel of capitalism.
Speaking of social media and Twitter, you see the stats I dug up here? I saw on Twitter this afternoon. The question being raised by this post was, what impact will Twitter have this time compared to 2008? So I just dug up the data. So in 2008, Twitter had 6 million users. Wow. Now it's over 328 million users. And look at Facebook. Facebook had 100 million monthly users in 2008. Today it's 2.2 billion monthly users. So
what does that do, though? It makes information spread more quickly? Does that make markets more efficient?
Does fear spread faster? Do people look for people when things go bad, people want to take action? So now will they be perhaps looking for other strategies if you don't have a sound strategy that you believe in now?
But are the people trading the ones on Twitter? Who's doing most of the trades? The institutions. Are the institutional traders sitting on Twitter waiting for their signals to sell?
I don't know.
I don't know either. I think there's an argument that it can make markets more efficient because like you can do the $ hashtag thing to talk about stocks. So people are very easily able to share information across a big platform with tons of users.
But there's also a ton of data going out showing these arguments that we're making, which is this is kind of normal. Some people do some really cool data point analysis.
Well, this is normal. There's no argument about that. But the challenge is, even though this is completely normal, we talked about this last time, I think, people have a bias for action. So that the market's going down, stuff is happening, you feel like you have to do something. And that's probably normal. That's probably an evolutionary response to danger.
Definitely.
Yeah. So people feel like they need to, I don't know if it's going to cash or if it's changing the strategy or buying a different fund or whatever it is. But we've always got to keep in mind that even if, make the assumption that you can time the market perfectly on the way out. So you know through some clairvoyance that the market's going to drop. So you get out. Okay. Step one. Now what? You got to get back in. When do you get back in? I mean, you don't know. And we've got to think, if you think about...
So someone has to buy it from you, right? And they're wrong.
Right.
So they're making a mistake by letting you out. And then they're going to be dumb to let you back in at a low price. Like because there's always a counterparty on every trade.
Yeah. I found
a lot of smart people on the counter side of the trades.
Right. I found a great chart from Vanguard, and they showed that 12 of the 20 best trading days, and this is for U.S. markets, from 1979 through 2018, occurred in years with negative annual returns. So you see a fantastic day, best day you've seen in years on the market. So you decide, okay, I'm going to get back in. It's time. Pretty good chance that day is going to occur within a year that is negative. And the same thing was on the flip side. 9 of the worst trading days occurred in years with positive annual returns. So again, you see a terrible day, so you get out. Pretty good chance it was a positive return. The other piece of this market timing discussion is that returns come in bursts. If you miss the good days, which you can't predict, there's a pretty good chance your returns are going to be your returns will be substantially lower than if you just stayed in.
Well, one of the best analogies I ever heard on this was going to a hockey game. So the hockey game starts, it's no score, and you go and get a hot dog, and all of a sudden 2 quick goals while you're not in your seat. So the point is to be in your seat. You don't know when the goals are going to be scored.
Yeah, exactly. And there are different things that people try and do, like using, for example, the Shiller Cape is a common one. Cyclically adjusted price earnings. So if the market valuations are high, well, you use that to get out and use that to get back in. There have been studies done on this as well. And it over 10-year periods explains about 50% of the difference in returns. So, I mean, even 50% in itself is not great, but that's only over 10 years. You shorten the time frame, 1 year, pretty well zero explanatory power. So if you're trying to time the market using the price earnings, there's no data to support doing it.
So as you'll hear next week in the podcast, one of the things that Dave mentioned Dave Getch, is to embrace volatility, embrace the risk. And this gave him a tremendous amount of peace in his life. So I think that's the key takeaway. Embrace risk, understand your strategy.
Embrace risk. Absolutely embrace risk. You need risk. If you're not taking the right kinds of risk, if you're not taking risk, you should not expect a meaningful
Why would you deserve
return.
higher expected return if you didn't take on the risk? It makes no sense.
It doesn't make sense in a capitalist society anyway.
Anyways, that's good for this week.
All right. So everyone enjoy your holidays, and I hope you enjoy the episodes that we have coming up, and we will be back with new material in the new year.